In this week's update, what could a Middle East war do to global equities? Big commodities boost from events in China and the Middle East, and investing for all seasons. My name is Garry Davis, and I'm an authorised representative of Primary Securities Ltd. Any advice is general advice only. Your personal objectives, financial situation, or needs have not been taken into consideration. Let's start with a global perspective. So what is driving equity markets at the moment in the medium term? Well, certainly in the last month, the massive stimulus announced in China has precipitated a very, very large rally, the biggest rally in the Chinese stock market since 2008. So that's certainly one very, very significant change that's occurred in the short term. Of course, we've had the topping of interest rates in America, and the Fed cut by 50 basis points a couple of weeks ago, and also signalled from their forward intentions that there would be further rate cuts coming in the pipeline. So there are a couple of very major changes to the market. And now we've got the potential for war in the Middle East, and no one really knows how that's going to play out or the impact that it's going to have on equities markets. And so that's why your fallback position must be control what you can control and don't worry about the rest. Good investing is about successful risk management suitable for you. Look, it's very easy just to follow the same path. You know, we've all got busy lives, and for the majority of the population, it's investing is something just to get it done quickly and move on to other more interesting things. So it's very easy just to get into a pathway, get into a rut, if you like, and just follow along the same path. But it's never been more vital, because the world is changing ever more quickly, to remain flexible to these changing circumstances, because they're getting more significant and they're getting more abrupt. Don't get stuck clinging to old investment positions that you've had for years that just aren't working. And over recent weeks, I've been showing some that haven't worked for a long period of time. So don't get stuck in that situation. Avoid following the crowd. Avoid following consensus thinking. And when the balance of probabilities shift in terms of where the money flows are going and where the investment profits are to be made, then be decisive and just do it. But first of all, you've got to be aware of the shifts that are changing and be prepared to change with them. So it's all about having a guiding process, being able to make decisions more consistently. And I've been doing these videos now for 17 years, just about every week of the year. And I do it because it's vital that investors have a perspective on markets that doesn't have vested interests attached to it. It doesn't have strings attached. And that perspective on what the markets are doing and also what good investing principles are, I think is absolutely vital. And that's why I keep turning up, every Sunday and doing this year after year, because I think it's important. And I'm in a position where I can make a contribution. So this video contains facts, obviously, about what's going on in the market, what the S&P's done, what the Australian market's done, what gold's done, all those sort of things. But you can get that from lots of places. There's many, many websites where you can get that information. This pulls it together in a very succinct package, but it's nothing earth-shattering. The most important thing that this video addresses, and I do it nearly every week, are the principles of investing that work really well. Principles that I've learned over more than 3 decades in the market. Now, these principles are simple, but they're not easy to do. And they're not easy to do because of how we're wired psychologically and how we are easily influenced by the investing environment around us. So the biggest challenge that we as investors face is that the environment keeps changing, it keeps evolving. I mean, just think about what's happened in the last 4 or 5 years. This is a chart of the US Fed's funds rate going back to before 1960. And you'll notice the period through the 70s and then into the 80s where interest rates were between 10 and 20%. And we never want to go back there again. For anyone that lived through that, it's not a place we want to go back to. So if you think about why central banks are so paranoid about getting inflation under control, then this chart will tell you all you need to know. And So we had a 4-decade decline in interest rates starting in the early 1980s, and we got down effectively to zero, particularly with COVID. That period of 4 decades has now changed. The interest rate cycle, the long-term interest rate cycle has changed, and we're now heading back up again. How far and the trajectory remains to be seen. But that is a very significant change, and you can't have that sort of change after 4 decades of going one way and then turning around and starting to go in a different direction and not having an impact on how you invest. It's just illogical to expect investing to have stayed the same. Let's look at some other things. So the interest rate cycle has changed. Critical minerals, they boomed and then crashed. And it was just so logical. Everybody had bought into the energy transition, the decarbonisation imperative, electric vehicles. Everyone was going to be driving one. And it was just going to be amazing. It was going to be a gold mine of our lifetime. But it only lasted a couple of years, then it fell over. And it still really hasn't got back on the rails yet. So if you're an investor who depends on logic equals a certain response in the market, then logical outcomes went missing. There's just, so many things that just don't make sense anymore. US big tech crashed as the interest rate cycle started going up. And then it's turned up again. So we've seen enormous changes there. Let's have a look at a couple of charts. So the critical minerals boom and bust. This is IGO, probably no better example being across lithium and nickel. The price boomed from $4 to $17 and then promptly crashed again. And that just defied logic, if logic was all that you were looking at. Let's have a look at US big tech. This is NVIDIA, the real poster child of what's happened with big tech in the US. We had quite a decent rise that ended at the end of 2021, and through 2022, the price of NVIDIA fell. Doesn't look that much on this chart, but I'll tighten that in a minute. But it fell from $34 to $12, $11.50. That's a crash. No question about it. But then it all turned around and it boomed. If we just get rid of that, you can see that's a pretty significant decline in one of the world's most important companies. But then look at what's happened. So if you missed any of these turning points by even a few months, then you either did a lot of damage to the value of your portfolio or you missed, again, an opportunity of a lifetime. So it's being able to see these turning points, turning point here, turning point here. It's being able to see and understand and react to the opportunities that these turning points create that is just so important for your success as an investor. And then, of course, we've had small caps that have been shunned for years are now starting to gather favour. Now, it's not universal. It's the really, really good ones that are doing spectacularly well, and others are still languishing as they have for years and may continue to languish. But certainly there is a rotation towards small caps that have got the credentials for the price to go higher, that warrant a higher share price, are now getting that reward from the market. So there's another very major shift. So if you just keep doing the same thing over and over, then, guess what is going to happen? You're going to get left way behind as an investor. And if I can't do anything else in this video but get that message across, that you've got to start doing something different if you're not getting the results you want, then I just don't know what else I can do, to be honest. So what are the processes that I use and teach? What do they deliver? So it's about process. It's about staying alert to the changes. So these results that I'm going to show you, these are from accounts which are managed by the VFS Group. Their AFSL number is 418418, and are taken directly from the Interactive Brokers platform and their actual performance figures. So these come from the processes that I use, the stock selection, the weightings, the trade management that I use and teach through all my services, the Insiders Club, Portfolio Analyst, whatever it is. This is what's termed the Portfolio Manager service. So these results come from a period when there's been very significant changes and abrupt changes in both directions. So it underlines the importance of having a process that can get you through those rapidly changing periods. So this is FY23, 15.8% was the return. And of course, with all these performance figures, past performance does not guarantee you what's going to happen in the future. But I would have to say that having consistent processes that deliver certainly improves your odds about what's going to happen in the future, but it certainly doesn't guarantee it. FY24, 20.59% over that financial year. And so far in FY25, the first quarter was almost 10% for the first quarter. So you can see that these results are well above average. And you might also note that whilst it's a relatively short time frame, they're also accelerating. And accelerating during a period when things have been pretty tricky, unless you're really on top of those changes. So for anyone who wants to be more hands-off with your wealth creation, but be able to keep control and visibility in an account, which is an individually based account in your name, then I'd invite you to contact me for more information. So that's the Portfolio Manager service. Alternatively, if you want to learn more about how to do this yourself to achieve consistent above average returns and be able to manage it all yourself, then take a look at our flagship service. It's a full management service called the Insiders Club. And I just need to repeat again for make sure that we're absolutely compliant with what is required. This is general advice only. I'm not taking account of your specific circumstances, your financial needs, or anything else because I don't know what they are. This is just general advice. The third alternative is you could use me as, call it your seasoned analyst, if you like, for question and answer, for stock recommendations and also for market strategy, and that's the Portfolio Analyst service. There's a $1 trial available in that service, and I'm always happy to discuss the repeatable processes that I've been talking about in this video. That's what stands behind what we do. It's not just random stock selections and, oh yeah, we'll get in here or we'll get out there. It's a very repeatable, consistent process. All right, moving on. So before I get to the charts, we strongly advise that you obtain your own investment, financial, legal, and any other advice that you might require before taking action. And hopefully everybody understands that when you're investing in the stock market, you can suffer loss of funds. So you've got to get this right because it's all too easy to lose money in the stock market. If you like these videos, then please click on the like button because that helps our ratings. But also you might want to subscribe to this video if you are not getting it automatically every week as it is. It's free. And I try to put in as much objective perspective about what's happening in the market that I possibly can. All right, let's moving on to what has been happening out there in the world. The S&P rose a little bit for the week, the fourth weekly rise in a row. It took a decent Friday night to get there, but it did in the end. The Nasdaq was up similarly, but we did see the equal weight S&P down just a fraction, and also the Russell 2000 also down 0.5%. So it was a case of, for most of the market, sentiment was pretty subdued. The obvious reason for that was what was happening in the Middle East. But then a jobs report, which easily beat expectations by a big margin. That provided a boost to the market, which is really interesting because, and this really underscores the difficulty in applying logic to the market. The market could have gone either way. It could have looked at those unemployment results and thought, jobs market is so strong that the Fed is less likely to lower interest rates further. And therefore the market could have been negatively impacted. And a lot of times that has happened in the last couple of years. Or, as it has chosen to do, at least for the moment, is to look at that and say, well, the US economy is going along really well, isn't it? We're producing all these new jobs, so that's great for the economy and good for the stock market. So when you've got markets that can react two completely different ways to the same piece of information, it's when you really understand that this is not about the application of just logic. If you just apply logic, then you're going to struggle. You need risk management processes. You need to be able to read chart patterns to really be on top of what's going on. The US dollar shot up higher, up to 102.5, of course, related to that jobs data. That pushed the 10-year yield up also to nearly back to 4%, and the VIX went a little higher because of the difficulties in the Middle East. So let's go look at some charts on these. Okay, so there's the Russell, down just a little bit on a weekly chart. That's the equal weight S&P, again, fractionally down. But that's the S&P index on a weekly chart. So another week, and in fact, since the big sell-off that we saw on August 5, which was all about the unwinding of the yen carry trade and all those sort of things, we've had 8 of the last 9 weeks have been up. We had one significant week down, being the first week of September. But since then, it's been a pretty rapid move back to the upside on the S&P. And you don't need to know anything about the market. You just need to step back and look at that chart and ask yourself whether it's going up or it's going down. Let's not overcomplicate investing. And this is clearly going up, and it's going up at quite a good clip as well. And you can argue about whether that's justified or not based on valuation grounds, but the fact is that it is. And there are many, many stocks that are going up much, much faster than this. So there is opportunities in the market is the key message. There's the NASDAQ, also just up fractionally on a weekly chart, but getting down into the weeds. This is the semiconductor index, also gained very fractionally, but at least it has stopped falling. We saw a very sharp fall that started in the middle of August. And again, this is related to interest rate differentials, particularly between Japan and America, and the interest rate carry trade and the implications that has for stocks. There's the semiconductor index versus the S&P. We're just gaining a little bit of ground, but certainly it's steadied. I think that's probably all that you could say at the moment is the ratio, the money flows into semiconductors relative to the rest of the market has at least steadied. It stopped declining. So that's a vital first step. Consumer discretionary versus consumer staples, a little bit more improvement during the week, but we're still within this overall range, which would indicate that money flows are not really favouring one side or the other. Over the last month, this is what's happened in the US market. You can see the red line there is consumer discretionary, and the green line is technology, and then we've got communication services, and then energy has certainly made a very rapid move in the last week from the bottom of the pack to right up there near the top. So that's been a sudden shift. And that, of course, is because crude oil jumped up something like 9% last week. So that is the US market. The Aussie market over the last quarter, information technology has been leading most of the time. We had a dip with that initial sell-off, but other than that, information technology continues to do very well. Banks were also doing very well, but they have come off quite sharply, and I'll show you another chart in a minute in terms of relativity. It's just a little bit cleaner. And then we've had materials also regaining some ground, just turning down a bit in the last few days, but certainly gaining some ground from where they were. And similar situation here with energy, which had been dragging the train in Australia for quite some time, is having a bit of a day in the sun, but I suspect strongly that that may not be sustainable. So the other relativity chart that I would like to highlight is just this one. And I covered this a couple of weeks ago, that the bank valuations at the moment are very unattractive. They're trading beyond the normal PE ranges, and the valuations just are not attractive relative to the sector or to the rest of the market. And the Australian economy is hardly heading in the right direction. There are just so many issues that are going off the rails in Australia that bank valuations being at these sort of peak levels just do not make any sense at all. And I think finally the market appears to be waking up to that. And we've seen a sharp flow of money out of the banks and, of course, coming back into resources because of what's happened in China with their stimulus. It's always tricky trying to get the timing right on resources. And it may well be that the banks are coming off merely to fund this reversal of money flows into resources. The money's got to come from somewhere. But nevertheless, bank valuations are very unattractive anyway. While we're here, let's just have a look at the currencies. So there's the US dollar index on a daily chart, quite a sharp move. And if we put that on a weekly chart, you can see that's quite a sharp week. We don't get too many weeks where the currency moves by that degree. And of course, that has propelled the Aussie dollar in the opposite direction. So we're now back down, heading back down into the range that we've been in for quite some time. You've got to go back more than 2 years. So that's the US market and relevant currencies. If we look at our market, 67.32 is where we finished. The ASX 200 was down 0.75% on the weekend, but markets are very flighty at the moment. They're very nervous. So I have really no idea what's going to happen early next week. It will be dependent to a large degree on the news that comes out of the Middle East. The very significant sector rotation we've looked at. Gold also did well, as we'll get to in a minute. But in the Australian market, that was about it. Other than some individual really good trends, there wasn't really anything much on a sector level. And in fact, 9 of the 11 sectors were down. Turning now to precious metals. Gold, despite what you would think, again, his logic doesn't always equal result in the market. Gold was down by $5 to $26.54. We're on the brink of a possible very, very bad war in the Middle East. Interest rates going down. The formula for gold to go up dramatically is all there, but it didn't. So once again, your actions have got to be guided largely by the charts and the money flows. The charts are telling you what the money flows are doing. In Aussie dollars, it's now above 3,900. So Australian gold producers are making money hand over fist at this sort of level. Despite the fact that gold went down, silver actually went up a little bit and finished at 32.4. We had a surge in the US dollar, so that is certainly part of the reason that gold was down. But then we've got the geopolitical premium as well. So one is sort of balancing out the other, and that's why gold in the end didn't do a great deal. When it comes to the actual stocks, local producers should be roaring. They should be doing a lot better than they are, but they're not. I don't have an explanation for why that is. It is what it is. And so you just manage your portfolio and manage your risks accordingly. Let's go and look at those charts. We'll start with silver. So there's the silver chart. We actually spiked up quite nicely on Friday and actually almost got to $33. So it's just had a little peak. So this is as high as silver has been. You've got to go back to 2012 to find silver at the level that we touched on Friday night. So this is starting to look very much like the emergence of a new trend. We've been in consolidation in silver now for over 4 years. It could well be that this is the start of a new uptrend. And that's the US dollar gold price. So just on a weekly chart, so just down a couple of dollars for the week, but it's still a very strong uptrend. So I think that's more about the US dollar rise offsetting the geopolitical premium. And in Australian dollars, that's where we finished. So again, a new all-time closing high in Australian dollars at over 3,900. Okay, turning to other commodities. Copper was steady at 452. So was nickel. Crude oil, which had fallen significantly over the last few weeks on concerns around growth in China and growth globally, has spiked back up again, of course, with the possibility that we could see significant disruption to oil supply in the Middle East. So back to 74.32. It's a new uptrend. It's short term. If things were to settle down in the Middle East, then the oil price would certainly move back down fairly sharply. But, who knows what's going to happen there. But oil is still down if you look across 2024 as a whole. Now in Australia, and I've been saying this for years, and I pretty much haven't touched them for years, Australian energy policy is just such a dog's breakfast. It's an absolute mess. And I just couldn't invest in any Australian energy company with any degree of confidence because of that energy policy. It's a complete disaster. And that's just not the current government. It's a succession of governments. So I only invest where I feel that there is a high degree of confidence about how things will play out, and I cannot engender that confidence in the Australian energy market. And you've only got to look at the charts of Woodside and Santos and stocks like that to see they're just top performing. But when it comes to energy, there are strong opportunities overseas. So, energy certainly has its place, but very, very difficult in Australia. Uranium, the spot price hasn't moved, it's still languishing around the 81, 82 mark. But again, the spot price is just such an insignificant part of price discovery in the uranium market. Most of it is done on contract. It's not visible to us. So, it's very difficult to know really what is happening with pricing in the uranium market. But look, the industry is certainly improving. I talked about this last week, the fact that we've now got 12 or 14 of the world's largest investment banks are now committing to the development of the nuclear industry in terms of lending. That's a huge shift, a huge statement by those banks. We're seeing countries increasingly turning to nuclear for their power generation. So there's no question that the industry is moving ahead rapidly and that will continue for a long period of time. And now stocks are starting to turn up into more powerful uptrends. There's some short-term factors that are contributing to that are transient. So, this is not just a one-way street to higher prices, but certainly the long-term underpinning fundamentals certainly are there. There's the spot uranium price. All right, just covering off the other charts. There's copper, sort of been sitting around the 450 mark now for a few weeks. And there's the crude oil price chart. Got down to 66, but it's now recovered to 74, but still down on the year. All right, wrapping it all up. Market dynamics. There's a lot of things going on that confuse the logical conclusions. If you don't have an understanding of what happens in the bond market or what happens in currency markets, how that finds its way into the equities market, then you're only investing with a small fraction of the information that you need. You've only got to go back to August with the change in, or the perceived change in, interest rates between America and Japan, and what that did to all asset classes, most notably equities markets. So there are things going on that are outside the equities market that you've got to have an understanding of. And that's why you've got to be flexible. If sometimes things just don't make sense, but they're changing for reasons outside the equities market. So if you are relying solely on fundamental considerations, I'm sure there'll be many people that will disagree with me vehemently on this, but if you are relying solely on fundamentals equals XYZ should happen in the market, then I think that is actually worse than doing nothing, doing no fundamental analysis at all. Because if you do the fundamental analysis and that's all you rely on, then it's easy to take a fixed stance and not change it. So I think if you want to do some fundamentals, that's fine. I use fundamental analysis to improve my odds of success, to make sure that I'm in the right ballpark when it comes to stocks that have got a higher probability of being supported in the market and going up. So that's fine. But if that's all you use, then I think you're going to run into difficulty. The rest is about using chart analysis to manage risk. What are the money flows actually doing, and how does that feed into my risk management plan? That's how you end up being a successful investor. portfolio analyst last week. It was a taking stock edition, which is clearly focused on education and learning the lessons that we can take out of the things that we did and we analysed in September, but also for Q1 as well. So that was a pretty well-rounded session. All right, there's more information on the website. Here's my email address if you wish to communicate with me. And I'll be back with you next Sunday. And I'm sure it's going to be a week that's going to have a lot of very important stimulus, not only economic data, but also the geopolitical situation as well. So I think I'll have plenty to talk about next Sunday. So that's it. I'll be back with you then. Cheers.